Hello students, Banking Theory and Practice, Unit 1, Introduction. Lesson 1. In today's class, we focus on origin and growth of banking in India. We study unit versus branch banking. Let us discuss in detail regarding origin and growth of banking in India. The money lenders, banking firms, private bankers of India were called as indigenous bankers by the British. The hundi is another financial instrument which was used for payment on demand or after a specific time limit to a person whose name is written on it. It worked well, and even the royal families followed this system of traditional banking in India. Banking system in India started in the year 1770 with the establishment of the first joint stock bank, namely the Bank of Hindustan by Britishers in Calcutta. In 1806, Commercial Bank was established in Bengal. Bank of Bengal, Bank of Mumbai, Bank of Madras, together called Presidency Banks. These banks are financed partly by East India Company. In the year 1881, the first indigenous bank, Oudh Commercial Bank, was created. The term bank is derived from an Italian word, banco, which means bench. The bench signifies the benches that were used in the marketplace of Italy by Lombard Jews to exchange bills and money. In India, banking system can be traced with the establishment of Bank of Calcutta in the year 1786. In the 18th century, English agency houses were founded in Bombay and Calcutta, which became the source of origination of banking in India. In the year 1935, Reserve Bank of India was established as the Central Bank of India on the recommendation of Hilton Young Commission, which offered financial aid to the urban population only. After the independence, banking sector of India was taken under private ownership in order to provide financial aid to both urban and rural population. Reserve Bank of India was nationalized in the year 1949 by the Government of India. Many other major banks were also nationalized for the development of national economy. In the year 1990, liberalization of banking system was started to improve the profitability and financial stability of public sector banks. The evolution of Indian banking system is divided into four different phases: the pre-independence phase, 1947 to 1967 phase, 1967 to 1991, 1991 to 92, and beyond. Let us focus on the pre-independence, pre-1947 phase. During this period, many banks were established as there were not set standards for entry. Some banks which exist even today are the result of Swadeshi movement. This phase witnessed the failure of several banks and was marked by two world wars and Great Depression. The global pressure and mismanagement of banks were the two major reasons for the failure of the banks. The Reserve Bank of India was therefore established in the year 1935 to overcome such failures. The absence of an appropriate regulatory framework restricted the control of Reserve Bank of India over the banks. Coming to the second phase, 1947 to 1967, the Banking Companies Act was introduced in the year 1949 in the post-independence era for solving the issue of banking failures. The safety and soundness of the banking sector was improved by the Reserve Bank of India. This act also granted the authority of regulating and controlling the banking sector to the Reserve Bank of India. The introduction of deposit insurance boosted the confidence of the depositors in the banking system. The banking system was also expanded in the rural areas. Reserve Bank of India efforts to ensure adequate credit to productive sectors resulted in the development of complex regulated interest rate structure. 1967 to 1991, the number of banking companies have come down from 648 to 89 by 1969. The Narasimhan Committee 1991 acknowledged the tremendous changes of public sector banks in 1969. Strict social controls over the banking sector was witnessed from 1967 to 1991. Direct lending to the priority sector was introduced for assuring equal flow of credit to agriculture as well as small scale sector. The banks expanded rapidly without considering the profitability and asset quality. The medium and large firms faced the credit problems due to strict targets for the priority sector lending. This resulted in the acquisition of many non-performing assets by the banks. In 1990s, the financial sector of India had the following characteristic features: controlled and regulated interest rates, high rates of cash reserve ratio and the statutory liquidity ratio, which resulted in the withdrawal of a large amount of resources from productive lending, the extensive flow of small funds among the banks, the accounting practices were not transparent and has a limited disclosure. There was a large public ownership and decreased efficiency and productivity. There was small amount of capital and large amount of non-performing loans. Huge investment was made in government bonds, which facilitated high government borrowing at concessional interest rates. There was limited access to private sector banks. This phase also witnessed lack of depth in the capital and foreign exchange markets. The development of the financial system was also restricted as monetary policy was given less importance than the fiscal policy. Now let us focus on the fourth phase, 1991-92 and beyond. 1991-92 was one of the most productive phases in India's banking industry. This phase is divided by Reserve Bank of India into two sub-phases, 1991-92 to 1997-98 and beyond 1997-1998. In the first phase, a powerful committee on the financial system was established by the government under the chairmanship of Mr. M. Narasimham. The committee became popular by the name of Narasimham Committee. The 5 principles that guided these reforms were cautious and sequenced reform measures, introduction of reinforcing standards, introduction of complementary reforms, development of financial institutions, development and integration of financial markets. The first subphase focused on improving the profitability, competitiveness, capital position, and asset quality of banks. Risk aversion was also developed by banks. The second subphase of 1997-98 showed a shift towards the prudential standards with the international best practices. The private sector banks were permitted to operate, which lead to an increase in the competition. The number of non-performing assets were decreased sharply. During this phase, the technology was introduced into the banks. A high-level committee was established in 2007 under speeding the chairmanship of Professor Raghuram Rajan for speeding the financial sector reforms. The following are the committee's terms of reference: recognizing the emerging challenges for fulfilling the financing needs of the Indian economy and identifying real sector reforms which helps those needs to be met easily by the financial sector, analyzing the performance of different segments of financial sector and recognizing changes which helps in meeting the needs of real sector, identification of changes in the regulatory and supervisory infrastructure which facilitates the financial sector to play its role, identification of changes in the areas of economy and the conduct of monetary and fiscal policy. Annexure 2 presented 35 proposals which was created by the committee. Annexure 3 outlined the major policy and legal reforms which occurred in the Indian banking sector since 1991-92. Now, let us discuss what is a bank and what are its features. The term bank is derived from a Greek and Italian words bank and banco, which means a bench, which is used by the money lenders to display their coins and making business transactions. However, in the modern world, bank is referred as the financial institution which accepts deposits, lend and creates money from financial sources. According to Walter Leaf, a bank is a person or corporation which holds itself out to receive from the public deposits payable on demand by check. The Banking Companies Act 1949 defines bank as a banking company is defined as one which transacts the business of banking, which means accepting for the purpose of lending or investment of deposits of money from the public, repayable on demand or otherwise, and withdrawals by check, draft, order, or otherwise. According to Horace White, a bank is a manufacturer of credit and a machine for facilitating exchange. Characteristic features of banks. Bank deals with the money deposits of the public as it is a financial institution. A bank can be either a firm, organization, company, or financial institution which performs the banking functions or carries out the banking business. An important feature of bank is that it accepts deposits from the public, repays them either on demand or after the expiry of a fixed period. It safeguards the customer's deposits. It plays the role of a custodian of the public deposits. Banks provide loans and finance to the individuals or to the organizations as per their requirements. Banks offer various services to its customers, such as various payments and withdrawals, facilities like a check, draft, ATM, and so on. It also serves its customers by rendering agency and general utility services. A bank is a profit-making organization or institution which basically follows a service-oriented method. Bank acts as an intermediary between lenders and the borrowers. The main objective of the bank is to perform the banking business. Now let us study about the various types of banks. Central bank. The central bank is an autonomous institution which holds powers and control over the entire banking system of the country. In India, the Reserve Bank of India is the central bank of the country. According to R.P. Kent, central bank is the institution charged with the responsibility of managing the expansion and contraction of the volume of money in the interest of the general public welfare. Commercial bank. Commercial banks or business enterprises which are involved in finances, financial instruments, and provide financial services for a price which may be in the form of interest, commission, or discount, and so on. They accept deposits of money from the public for the purpose of lending or investment. Banking Regulation Act 1949. The banks are categorized into public sector, private sector, foreign sector. The different types of commercial banks are deposit banks, industrial banks, savings banks, agricultural banks, exchange banks, miscellaneous banks. Deposit banks. It is one of the types of commercial bank which deals with short-term deposit and loans. Deposit banks accepts deposit from the public and lend money to the customers who are in need of loans. Deposit banks extend loans for a short period ranging from 3 to 6 months. Industrial banks. Industrial banks extend long-term loans to the industries which require huge capital for buying heavy machinery and equipment. Moreover, they also deal with the process of buying shares and debentures of companies, which would help the companies to hold fixed capital. Industrial banks perform accepting long-term deposits, extending long-term loans to the industries, helping the companies which deal with the purchase and sale of shares and debentures. Savings banks. Savings banks are basically started with an aim to encourage the small savers like poor or middle class customers to save their money in the form of deposits in these banks. However, in India, due to absence of such banks, post offices perform the function of savings banks. Agricultural banks. Agricultural banks are of two types: agricultural cooperative banks, land mortgage banks, and cooperative bank. Agricultural banks are established to help the farmers by providing short, medium, and long term loans. Exchange banks. Exchange banks are the commercial banks exclusively deal with foreign trade, such as discounting, accepting, and collecting foreign bills of exchange. They perform the functions of buying and selling foreign currency. These banks also provide services like other ordinary banks. Miscellaneous banks. Miscellaneous banks are special kind of commercial banks which are established to meet the specialized needs of the customers. Organization structure of commercial banks. Commercial banks can be divided as scheduled commercial banks, unscheduled commercial banks. In scheduled commercial banks, we have nationalized banks, private sector banks, regional rural banks, foreign banks, public sector banks. The scheduled commercial banks constitute those banks which have been included in the second schedule of Reserve Bank of India Act 1934. The scheduled commercial banks are further classified or subdivided by Reserve Bank of India as public sector banks, old private sector banks, new private sector banks, and foreign banks. The composition of scheduled commercial banks in India or 300, which include the State Bank of India and its associated banks, nationalized banks, private sector banks, regional rural banks, foreign banks, etc. During 1994-95, 10 more banks were added in the scheduled commercial banks and the Bank of Karad was taken over by Bank of India. The total number of branches of scheduled commercial banks was 64,918, of which 36,679, that is 56.5%, were located in rural banks on 30th June 1999. Unscheduled commercial banks. Unscheduled banks are the banks which are not included in the schedule of Banking Regulation Act 1949. These types of banks can function in all banking sectors and there are no statutory restrictions on unscheduled banks. However, since May 1997, there were no unscheduled commercial banks emerged in India. According to Reserve Bank of India, there are 4 types of non-scheduled commercial banks available in Indian banking sector. They are listed: Subhadra Local Area Bank Limited, located in Kolhapur; Coastal Area Bank Limited, which is located in Vijayawada; Krishna Bhima Samruddhi Local Area Bank Limited, which is located in Mahabubnagar; Capital Local Area Bank Limited, which is located in Pagwara, Navsari. Functions recently introduced in Indian commercial banks. Previously, the commercial banks did not help in providing financial assistance to small scale industry units, but the State Bank of India, along with RBI, initiated a scheme for provision of credit to small scale industries. This was seen more after nationalization in July 1969. The commercial banks have also introduced the lead bank scheme, where each district is allotted to one scheduled commercial bank for proper development of banking facilities. Reserve Bank of India set up a committee under the chairmanship of Shri P.R. Nayak to look after the supply of credit to the needed small scale industry units. This committee recommended granting of increased credit to small scale industries and providing immediate solution to the small scale industries problems. The commercial bank intimated the foreign banks to extend at least 10% of their net bank credit to small scale industries, according to a development report of IDBI. The commercial banks have provided the small scale unit with rupees 27,612 crores that accounted for 27% of total gross bank credit of rupees 1,02,953 for the industrial sector. Further, it was noticed that the bank credit to small scale industry units have increased from 22% in March 1993 to 27% in March 1995. Facilities offered to small scale industries are arrangement of finance, regional testing centers, tool rooms, central footwear training institute, facilities and concessions. Arrangement of finance, a network or group of state finance corporations, small scale industry corporation, National Small Industries Corporation, commercial banks, cooperative banks, regional rural banks extend financial assistance to small scale industry units The SIDB offers refinance to industrial loans already provided by them to small enterprises. The State Finance Corporation sanctions term loans for meeting the working capital requirements for setting up of new enterprise and for expansion or modernization of existing units. Regional testing centers. Regional testing centers provide testing facilities for raw material, semi finished and finished goods which are primarily manufactured in the small sector. Regional testing centers are located in Calcutta, Mumbai, Chennai, and New Delhi. These testing centers provide facilities in the field of chemical, mechanical, electrical, metallurgy, and metrology. They also assist in quality improvement and quality control of goods. Tool rooms. Tool rooms are tool design institutes, assist in tool designing, manufacturing of tools, fixtures, molds, dies, etc. These are about 10 tool rooms which are located in Kolkata, Ludhiana, Jalandhar, Hyderabad, Nagpur, Indore, Ahmedabad. The tool rooms are operated and run by state government mainly at Lucknow, Delhi, Bangalore, Mysore and Goa. Central Footwear Training Institute CFTI. The function of Central Footwear Training Institute is to train manpower in footwear industry, developing new designs of footwear to promote exports. Central Footwear Training Institutes are generally located in Agra and Chennai. Facilities and concessions. The central government extends a bunch of incentives and facilities to small enterprises, exemption and concession in excise duty to small scale industries, fiscal incentives, reservation of certain items manufactured for production and purchase. Classification of scheduled commercial banks. Reserve Bank of India Act 1934 comprises scheduled commercial banks in its second schedule. Scheduled commercial banks are further divided into four categories: public sector banks, private sector banks, foreign banks, regional rural banks. There are 81 scheduled commercial banks, out of which 26 constitute the public sector banks, 21 are reserved for private sector banks, whereas the remaining 34 belong to foreign banks. Public sector banks. Government has the chief authority in public sector banks. Public sector banks broadly classified into two categories: State Bank of India and its associates, and nationalized banks. State Bank of India. The State Bank of India was introduced on July 1st, 1955. The five subsidiaries under the State Bank of India include the State Bank of Bikaner and Jaipur, the State Bank of Hyderabad, the State Bank of Mysore, the State Bank of Patiala, and the State Bank of Travancore. The State Bank of India is the largest commercial bank in the world with an aggregate of nearly 16,055 branches, comprising 4,607 branches of its associate bank, 131 foreign offices in 32 countries, and 2,410 ATMs networked with SBI ATMs in India. SBI holds a total of 17% market share with an asset base of about 5,42,503 crores. It is considered as the country's largest bank wherein there exists 100 million accounts with a total workforce of about 2,14,845. SBI has funded 17 regional rural banks till 31st March 2009. SBI has 5 non-banking subsidiaries. The current plan of SBI is to make itself as universal bank, which helps in meeting the different needs of the society through reformation of its branches into super shop, wherein its products such as banking, insurance, mutual funds and credit cards would be sold. Nationalized banks. Banks are nationalized under the Banking Companies Act 1970. This phase of nationalization constitutes the second stage of nationalization. In 1969, nearly 14 big Indian joint stock banks belonging to the private sector undergone the nationalization process. During the third stage of nationalization, 6 commercial banks in the private sector with an average deposits of over 200 crore rupees were nationalized on August 15, 1980. Presently, there are 27 nationalized banks, the State Bank of India and its 6 associates, and 19 nationalized banks and IDBI. The main objective of nationalization was to provide financial assistance by network to the rural and semi-urban areas. Nationalization of banks objectives to provide major banking facilities exclusively to the rural and semi-urban areas, to spread awareness of agricultural finance and to overcome the causes for the downfall of the agricultural finance system, to facilitate the Reserve Bank in the formulation of its credit policies, to provide assistance to the government in carrying out the broad economic policies. Private sector banks. The Narasimham Committee stated in its report that the Reserve Bank of India should allow the establishment of new banks if they are capable of fulfilling the minimum startup capital and other requirements. Also stated that there should be no discrimination between the public sector and private sector. The banks established after the committee report are known as new private sector banks. In a recent scenario, there exists 21 private sector banks, out of which 14 banks are old, whereas the remaining banks are new banks. New banks generated profits from the first year itself. The public sector banks are facing heavy competition from the private sector banks. In January 2001, the guidelines relating to the establishment of new private sector were updated or revised. It recommended to raise the initial minimum paid up capital 100 to 200 crores. Further, the initial minimum paid up capital shall be increased to 300 crore rupees in the next 3 consecutive after the establishment of a business enterprise. It allowed non-banking finance company to transform into a commercial bank if it satisfies the following conditions: establishes with a total minimum net worth of 200 crore rupees, holds a credit rating of AAA or its equivalent ratings in the previous year, sufficient capital of less than 12%, and net non-performing assets whose worth not be more than 5%. The guidelines restrict the use industrial houses to advertise any new bank. The individual firms associated directly or indirectly with large industrial houses are only allowed to contribute a maximum of 10% in the total equity of a new private sector bank. The option would be provided to those promoters who are having expertise in financing the priority areas and also in establishing banks which are specialized in financing the operations of rural agro-based industries. Foreign banks in India. A survey conducted identifying the number of foreign banks in India on April 30th, 2010. A total of 34 foreign banks have been identified in India with 311 branches. Furthermore, 45 foreign banks are operating in India by establishing their representative offices. The Standard Chartered Bank consists of the highest number of branches, nearly 92 among all foreign banks in India. Some foreign banks have been operating in India over the 100 years. For instance, ANZ, Greenlace, and Standard Chartered Banks have been operating in India for more than a decade. Few foreign banks have established various entities that are operating in India as subsidiaries, constituting either the non banking financing companies or limited companies in the non financial sector, which comprise different businesses like dealing in securities, leasing, and finance, information and technology. Example, HSBC, Bank of America, etc. The RBI guidelines for foreign banks in India. In the first stage, from March 2005 to 2009, the eligible foreign banks were allowed to establish their presence by initiating a wholly owned banking subsidiary or by converting the existing branches into a subsidiary. For making the presence the wholly owned banking subsidiary is required to have a minimum capital of 300 crore rupees and a strong corporate governance for its operations. In the second stage in April 2009, the new foreign banks were permitted to operate in India if the banks were found to be financially sound, wherein they consider the international and home country ranking, rating, international presence, and economic and political relations between the two countries. The minimum capital stipulated is 25 million US dollars, which has to be divided among the three branches, where the first two branches get a capital of 10 million US dollars, while the remaining amount of 5 million US dollars must be allocated to the third branch. More branches are allowed after observing the operations of present branches. 12 licenses are determined in compliance with India's commitment make to World Trade Organization per annum for new and for expanding the existing banks. Foreign banks are required to lend an aggregate of about 32% of their adjusted net bank credit or credit equal to the off-balance sheet exposures, whichever is found to be more. Regional rural banks. The main purpose of regional rural banks was to deliver the rural credit facilities to the backward areas, thereby ensuring their financial soundness. Central government, respective state government, and sponsors like commercial banks are responsible for the contribution of initial capital base for regional rural banks. The regulatory framework of regional rural banks has been proposed by the Reserve Bank of India and NABARD. Andhra Pradesh Gramin Vikas Bank, Arunachal Pradesh Rural Bank, Baroda Gujarat Bank, Himachal Gramin Bank, etc. are the examples of RRBs. Now, let us focus on unit versus branch banking. Most common banking system can be divided into unit banking and branch banking. Unit banking system definition. An independent unit bank is a corporation that operates one office and that is related to other banks through either ownership or control. Unit bank system. An independent unit bank is a corporation that operates one office and that is related to other banks through either ownership or control. Under this type of banking system, the banking operations are usually subjected to merely a single office or, in certain cases, some offices in the restricted local areas. Usually, unit banks provide services through a single bank and do not have any branches. Under the unit banking system, different units of banks perform their functions independently. It is also called as localized banking. It is quite popular in United States of America where different unit banks are clubbed together through a correspondent banking system which has the benefits of branch banking. Merits of unit banking. We have uh, uh, the merits or advantages. First one is efficient management. Unit banking possesses all the benefits of small scale operations because of the small size of the unit banks, and as centralized banking operations there is less probability of mismanagement. Fast decision making. As every unit bank performs its own functions independently, the decisions can be made quickly and efficiently. Customer friendly. Due to its small size, the unit banks can maintain personal and face to face contact with its customers. Maintaining such a personal rapport helps in reducing the consumer complaints and grievances. Cost effective. Unit banks are more economical than the branch banks because of less number of operations and geographical coverage. This further results in greater profitability and lower cost. Decentralization. A unit bank can be opened with a small capital and with a less number of formalities. The unit banking system usually encourages the decentralization of banking business and prevents monopoly of the banking business. Coming to the demerits of unit banking, no division of labor. Due to its small size, division of labor and specialization cannot be followed in unit banks. This basically results in diseconomy of scale. Idle cash reserve. Unit banking usually needs large cash reserves because at any time large withdrawals can be made, and the unit banks are supposed to fulfill the cash requirements of its own branch. Huge amount of cash usually lies idle with the bank. Greater risk. Basically, the unit banking is confined to a limited area only. They usually rely upon limited customers. Any kind of minor environmental change may also put the bank at a higher risk. Limited mobility of funds. The mobility of funds in unit banking is very less due to its local functioning. As a result, the speed of circulation and economic activities are decreased in the economy. Limited banking services. Unit banks are small in size. They offer only a limited number of services to their customers, because of which the customers usually depend upon other branches for the other services. Improper supervision. Unit banks are difficult to be supervised and controlled because they function independently in various local areas according to the central banking authority and government. Thus, this increases the chances of fraud or irregularities. Now let us discuss about the branch banking, merits of branch banking, demerits of branch banking. Under the branch banking system, a single commercial bank is a very big institution which spreads its branches across different geographic areas of the country. Branch banking is also known as delocalized banking, as it allows the opening of number of branches for performing the banking operations. Branch banking system is quite famous in India. The following are few Indian banks which follow branch banking system: State Bank of India, HDFC, ICICI, S Bank, and so on. These banks provide a variety of services such as accepting deposits and cash withdrawals from a demand account with a bank teller, provide financial advice, insurance, sales, and so on. Merits of branch banking: economies of scale. Branch banking system gets all the benefits of the economies of large scale operations with the presence of greater applicability of the division of labor and specialization. The branch banks are usually large organizations. They can appoint efficient personnel and can engage right person at the right place, which would further result in efficient performance of the business operation. Economy in cash reserves. Branch banking mostly results in economy in cash reserves. A branch bank may usually hold little more cash reserve at one branch and a bit little in another branch. In case of sudden cash requirement, cash can be transferred from one branch to another branch. Economy of cost. Branch banking allows the transfer of funds easily from one branch to another at a lower cost when compared to unit banking. This is due to the fact that the indebtedness of interoffice can be adjusted without having an effect on the real transfer of funds. Spreading risk. A major advantage of branch banking system is the risk of business operation is spread over a large geographical area. Basically, business of branch banks is independent in nature. They can divide the risk with the help of diversification of the banking business, which helps in the reduction of failure rate. Higher degree of safety. Branch banking helps in maintaining higher degree of safety and liquidity by providing greater scope for selecting among various investments and different securities, and also because of their big size they possess good financial resources. Provision of complete banking service. Customers receive a complete package of service from branch banks. The customers can take the advantage of such services from any branch and need depend upon a specific branch for a specific service. Further, branch banks are also present and function in rural areas in spite of incurring losses. Such losses are usually adjusted against the profits of urban branches of the bank. Easy for central bank's supervision. The country's central bank can easily control and monitor the activities of branch banks. It can control the complete banking system by controlling the head office of different banks. Coming to the limitations of branch banking: mismanagement and misappropriation. Branch banking usually carries out in business with the help of number of branches at various locations. This may result in mismanagement and there would be lack of supervision and control over the branches. Delayed decisions and actions. A major limitation of branch banking is delayed decision making. The branch manager may not have the complete authority to take quick business decisions. Their decisions are dependent upon the directions of the head office and therefore needs their approval. Absence of personal contact. Another limitation of branch banking is lack of or absence of personal contact with the customers. Branch banks are big in size and are spread over a large geographic area. The top level managers may not get a chance to have personal contact with the customers and staff members of the other branches. Expensive in nature. Branch banking involves various branches. Establishing and maintaining a bank branch requires huge investments. This may affect the profits and revenue of the bank. Encourage monopoly. A major limitation of branch banking is that it creates monopoly power. Such power may become dangerous for the communities which aims at bringing socialistic changes in the society. Now let us compare or distinguish unit banking with branch banking. So we take some 16 points and each and every point we compare with the two banks, unit bank versus branch bank. Coming to the meaning, unit bank, it is a type of bank in which the banking operations are usually subjected to a single office. Branch bank, it is a type of bank in which a single commercial bank is a very big institution which spreads its branches across different geographic areas of the country. Scope, unit bank has a narrow scope. It is limited to single office and limited capital. Branch bank has a wider scope as it has many branches and huge capital. Efficient management. Unit bank has efficient management due to its small size and centralized banking operations. Branch bank, it does not have efficient management as it has number of branches at various locations. Quick decision making. The decisions can be made quickly and efficiently as unit bank is independent. The decisions are delayed until approved by the head office in branch bank. Funds mobility. The mobility of funds is very less due to its local functioning in unit bank. The mobility of funds is higher and funds can be transferred from one branch to another across the country in a branch bank. Cost effectiveness. It is more cost effective as it has less number of operations and geographical coverage in an unit bank. It is less cost effective as it requires huge investments to establish and maintain a bank branch. Cash reserve. In unit bank, the cash reserves lie idle. The unit banks, because any time large withdrawals can be made, and the unit banks are supposed to fulfill the cash requirements of its own branch. Whereas in a branch bank, the cash reserves hold little amount at one branch and a bit little in another branch. Cash can be transferred from one branch to another branch whenever required. Trade cycle. Unit bank is greatly affected by trade cycle as it is a single unit bank. Branch bank is less affected by trade cycle as loss of a specific branch can be transferred to remaining unaffected branches. Customer friendly. Unit bank maintains personal and face-to-face contact with its customers, which reduces consumer complaints and grievances. Branch bank does not maintain personal contact with its customers because of its big size and dispersion over a large geographic area. Decentralization. Unit bank encourages decentralization and prevents monopoly of business. Branch bank does not encourage decentralization, encourages monopoly. Risk level. Unit bank has higher risk level as it is confined to a limited area. Branch bank does not encourage decentralization and the risks are spread across all the branches. Safety. Unit bank does not help in maintaining higher degree of safety and liquidity. Branch bank helps in maintaining higher degree of safety and liquidity. Economies of scale. Unit bank does not have the benefits of economies of scale. In branch banking, we have the benefits of economies of large scale operations. Banking services. Unit bank offers limited number of services. Bank branch offers various banking services through various branches. Central banks supervision. The country's central bank cannot control the unit banks. The country's central bank can easily control and monitor the activities of branch banks. Competition. There is no competition in unit banks. The competition is very high as there are several branch banks in a given area.